Good morning and welcome to MarketCast 37. And I know it's getting a little bit threadbare now as we head in towards the second week of January, but Happy New Year. I hope you like the lobster shirt. This is to celebrate the fact that with effect from January the 1st, lobsters are now no longer able to be cooked alive by law. They have to be humanely put down before they're cooked. And that makes me, as a big lobster eater, very happy indeed. But more to the point, what has been happening in the property market and what is going to happen in the property market over the course of 2026. And I'm hoping that over the course of the next 30 minutes that we will actually be able to give you some real insight on what's coming, shed some light on it. I always like to pick a theme for the market cast, and this morning's market cast is no exception. And I was reminded, let me go back one. I was reminded of that classic movie, A Man for All Seasons, when I actually looked at the way all of the data suggests the market is going to move this year. A very strong spring, a much trickier summer, rebuilding in the autumn, and then depending on what's going on in the background, it could be a very strong finish for the year. And so I asked AI, as you do these days, to build me a movie poster, A Plan for All Seasons. I know, all right. You'll be laughing on your way home. A heartwarming tale of forward thinking and strategic planning, because that's what we're all about, and starring hopefully everybody that's watching the market cast here this morning. But I thought what we'd do to start before we get into the nitty gritty and the detail is take a little light trip back over the key events that actually set out 2025 and earmarked it for us. It was a very tough year, wasn't it? First of all, how did I get on? At this time last year, if you go back to my January 2025 market cast and have a little look at the forecast I made, how did I get on? Well, as you can see, I've awarded myself an A+, which is perhaps a tad presumptuous. I'll let you be the judge, really. But essentially, that is the forecast that I put in front of you a year ago, pretty much today. Within a couple of days a year ago today, I saw it with a reasonably good first quarter, good Q1. I saw a drop away in the summer and then a rebuild and coming out to a 1.5% in positive terms at the end of the year. And I had lots of detractors at the time, let me tell you, but we stuck to our guns. The reality was this. So as you can see, we had that strong first quarter. We did have a bit of a dip in the summer, not as deep as I had anticipated it was going to be. And then we were aiming beautifully for the 1.5% for the end of the year. And then suddenly the nationwide plummeted. I'm going to use the P word. It took a bit of a plunge in December and dropped by 0.8% down to 0.6%. But we were still in positive territory. I was less than a percentage point out, and I think I'm going to give myself, well, I was going to give myself A for that. But then when we look at volumes, I forecast back last January that volumes, again against all the odds, were going to increase by over 15% on the year before and return to 1.2 million. Remember me saying to you the famous 5? And volumes were 1.2 million. So we absolutely hit that one on the nose. So I'm taking an A+. I'm giving myself the extra plus for that. A quick run through what happened. This is how we started out with all sorts of worries. I remember running this slide in that deck back in January, and I wanted this to look all a bit foreboding and a little bit concerning as we approached what I thought was going to be a very difficult year. We were worried about inflation. There was stamp duty stuff being talked about at the time. And we know, don't we, of course, that got manipulated during the year with the government change. Mortgages, interest rates, all of these things were things that were concerning us. And then, of course, come February, we had the Donald, didn't we? And I know that this year he's come up with a whole fresh wave of stuff to keep us terrified and entertained, probably in equal measure. But back then it was all about tariffs, wasn't it? He was slapping tariffs here, there and everywhere. And why does that matter to us in the property market? Well, of course, what it does is it affects the global economic structure, and that affects confidence, and that affects the property market. So it does apply to us. We invented a new word, terrifying. unfortunately, it never caught on. I can't understand why. Then we came into March and then the market just started to quiver a little bit. I was concerned right at the start of the year, and I stayed with those concerns throughout 2025, that the nationwide index, which is what we use as our benchmark, was slightly skewed as the market in the UK started to separate in part, with the Northwest in particular moving ahead very strongly, and the Southeast from the Midlands down starting to drag behind. So the index for us wasn't actually working terribly well. We knew that it was going to be a tricky year, and so it turned out to be. But I always felt that for those people that were actually really sharp and on it, nimble, flexible, and able to take a little bit of margin sacrifice, that the opportunities were actually there. So that was how we were looking at things in March. And then as we got in towards the summer, well, I could feel it was coming. That summer dip, that summer slowdown. I was starting to see the average sale per live site per week starting to fall. And whenever that gets down to 0.5, somewhere in that sort of, we know then that we're feeling the pain in the front line. And so we were expecting the summer dip, certainly in terms of volume, and the summer dip came. And yet, all of the indices still carried on putting out these positive numbers. And that's when we introduced the wolf in sheep's clothing. This was in July. So even though the nationwide was telling us that asking prices were going up when I was expecting them to be leveling out in the summer, selling prices going up, well, for me, that didn't reflect the situation in sales offices, the length and breadth of the UK, and certainly not from West East Midlands down and in the southeast corner of the UK, and the central south as well, of course. All markets where we found it particularly difficult this year. And then, of course, well, along came Rachel from accounts, announcing her budget about 37 years before the actual day. So what she could do then is completely scare everybody witless, because at that point then she then set about offering up all sorts of possible steps that she might take, which on one occasion included stealing your children and locking your dog up for 2 weeks. And that gave us what I called budget paralysis. And that really, budget paralysis really was a thing. If you look at the right move numbers, if you look at the first half right move numbers, 2025 compared against 2024, new sellers were 9% ahead. And buyer demand was 3% ahead. If you look at the second half, after the budget was announced and the budget paralysis set in, that fell from plus 9% for new buyers, for new sellers rather, to -4%, and for new buyers from +3% to -6%. So it was really evident, and it massively put the squeeze on in the second half of the year. I, though, did see that there was a window of opportunity there if you could give people that's really essential part of the whole psyche of the home buying process, and that is certainty. We even introduced at that point into our matrix an uncertainty index, and we've kept it there now. Finally, whatever they were going to come out with in the budget, well, I said, well, there's nothing we can do about that. We've done our very best. The lobbyists have lobbied. We've screamed from the rooftops. We've paraded in the streets. Now we are just going to have to make the very best of what they deliver. And of course, that came up with that classic Cora Hatch saying there, you can't control the wind, but you can adjust the sails. It was all about trying to do that at the back end of the year, wasn't it? And then in the event, what was in the budget? Well, nothing. And sort of also left, well, how did that happen? We've got a mansion tax, but it's on the blocks for years down the line. Stamp duty wasn't touched. The whole thing really was an extraordinary anticlimax after all the rumours that had gone around beforehand. So where does that leave us? If you look at what's going on in the press right now, well, there's some stories in here. I couldn't resist putting in the Zoopla story, 1.2 million completions for 2025. I think somebody mentioned that earlier. This was interesting here. This is last week in Property Industry Eye. HSBC fires the starting gun on 2026 mortgage rates. The institutions are falling over themselves to lend house buyers money. Make no mistake about that. And the rates out there right now are very competitive. We will, of course, take a look at those as we run through this morning. Interesting as well that Rightmove, in their December press release, when they put out their December numbers, they said that Boxing Day was their busiest ever. Now, okay, I can take that and I can leave that. And what people do at home at Christmas when they've all rowed with the rest of the family and nobody's talking to anybody else, they can all get on their phone or their laptop and go and have a little look, see what's on Rightmove. So I'm not necessarily saying this is a stream of new buyers, but it's the classic old consistent inconsistencies. If you look at those Rightmove numbers every year, of course, all that applies, that you do get people just browsing over Christmas, but the level of that happening is an important number, and that was at its busiest. And it's just one more factor that leads me to believe that Q1 of 2026 is going to be very strong indeed. Of that, I am confident, absolutely confident. Right, a quick summary then. We'll run through and then we'll get into the detail. It was a very difficult year. I believe that 2026, even though we've had an upturn in volumes back to what I call that famous 5 number, 1.2 million transactions a year, I think we're going to see it uplift further in 2026. But prices are going to be difficult to shift, particularly from Midlands down all the way along the south coast, and not just the southeast, but right down into the southwest too. The Rightmove index fell by a more than average 1.8%. It always falls in their December numbers, but if you look at the 10-year average, it's only 1.4%. So I think that asking prices, people realise that if they are going to get serious and be selling and buying in the first quarter of this year, they're going to have to get realistic about their prices. And I think that reflects that. An extraordinary plummet in the nationwide. So we went from 1.8% down to 0.6%, just when I thought it was going to hit it bang on the nose of 1.5%. Damn you, nationwide! But what was interesting is that consumer confidence bounced back in December. It all still sits deep in negative, and that dictates this very low rate of sale, the hard work that we have to do to get deals over the line. But it was a big bounce back from November into December. I'll talk about that later. And of course, as predicted, you heard it here first on MarketCast, we got that interest rate cut in December, didn't we? From 4% down to 3.75. We'll cover that later. Mortgage rates then edged down, all of that. But crucially, the suppression, that artificial suppression of buyers from pretty much when the budget was announced back in last September, right the way through to the end of the year, because by the time we'd got the budget out the way in November, we were running straight into the Christmas period too. So we've got a bunch of needs-based buyers in there that are ready to move come Q1 of this year. And I think the opportunity there is very, very good for Q1. Important dates then that we need to be thinking about, of course. The next inflation numbers come out on January the 21st. And at the moment, inflation is a good story. Have a look at this. So I know I sound like a repeating record, but it's so important to us. This dark blue line here. So the number that's in all the newspapers is the CPI, the Consumer Price Index, which fell from 3.6% unexpectedly down to 3.2%. I think the markets were expecting to fall, but not by that sort of level, 3.2%. For me, a really big driver is the owner-occupier housing costs. And look at that. This is this dark blue line that up here hit almost 8%. Right, if you go back now about 14, 15 months, and you can see where it's come from there, and it fell again in November. So it's now 4.5%, roughly about where wage inflation is. So if you like, that whole thing there has stayed static. Affordability continues to improve. That's very, very good news. And of course, it gives a bit of confidence to the MPC, because of course then they meet on Thursday, the 5th of February, and what we hope is that they'll have had a look at those inflation numbers and they will see that there is room for another cut. I certainly am not as confident about that as I was when I was talking in December and about the December cut. I think this is no better than 50-50 for a cut. And in fact, if somebody said to me, well, you've got to bet your house on it, I'd probably say they are going to stick in February. But as I always say on MarketCast, I am no economist. But of course, what they do is crucial to us. One thing's for sure, and one thing I would bet the house on, it ain't going to be going up. It's not going to be going north. And so that confidence that has actually come out right across the market with lenders will continue. And I think that then will support the sort of numbers that we're expecting to see in the first quarter. Here's where we are, 3.75%. And just in case we forget, so this is where Russia invaded Ukraine. This is where, when oil prices went through the roof, 16 interest rate rises in that period, and then they started to come back down last August. And it's extraordinary, isn't it? I say last August, August before last. In those 17 months or so, base rates have come down by 1.5%. That is a huge amount. And pressure is still downwards rather than upwards. So what that does to average mortgage rates is that makes them look like this. Remember, we were worrying in the last MarketCast, if you're a regular viewer, we were worrying that the long-term money, the 10-year money, despite the short-term downward pressure on interest rates, was still climbing. Well, you can see that has actually now started to come down a little bit. And for a 75% loan to value, which is this chart this side, that is a 2-year fixed with different LTVs. These are 75% LTVs with different terms. And that's the 10-year money there, which has come down to just about average blended rate there has come down to around 4.5%. Very competitive, and that's 10-year money, which tells us all we need to know about how the markets feel interest rates are going to go over the next few years. It's huge for us in terms of the confidence. And if we're talking of confidence, it brings us here, of course. This, for me, is the cheat sheet when you're actually trying to forecast how the market's going to move. Certainly in the short to mid-term, it never fails, because this is the very essence of how confident people are about spending their money and making those big life-changing decisions. Real quick explanation then again. This is the zero line, that yellow line through there. GfK asked 2,000 people every single month, are things going to get better or worse over the next 12 months? If they say better, it's a plus. If they say worse, it's a minus. If the majority of those 2,000 people say better, it will come above the line. If the majority say things are going to get worse, it will be below that line. So that's how it works. The red line here is the overall index score. And with that uptick that we actually saw going up to -17, so still deep in negative, that actually takes us back to where we were a year ago. That's really interesting. In that 12 months with everything that's gone on, confidence sits exactly where it was at -17 1 year ago. Looking at the other key factors for us, the way the UK economy is going to perform, well, everybody is still very downbeat. Everybody still worries about the economy. This still languishes down here, not quite record lows anymore, but very, very low. I mean, if I took you back 20 years, this blue line was above the zero. For us now, it seems permanently embedded, doesn't it, down at those lower levels. The green line, massively important. Is the next 12 months a good time or a bad time to make a major purchase? A car, a kitchen, some might say a house. And you can see with the uptick, good uptick in December, have a look at this. So let me take you back. This is December 23. There's 2 years worth of travel here. And you can see slowly but surely people are coming around to the fact that although the economy is in difficulties, we've got to stop sitting on the fence and waiting. We need to get on with stuff. And finally, this mauve line at the top here, your own personal finances, how are they going to do over the next 12 months? Are they going to get better or worse? And bizarrely, it still stays up there in positive. So, there is that resilience that individuals feel that no matter how tough the background is and the economy is in the UK and globally, that their own personal situation isn't too bad. All of this gives me a very good a very confident feeling about where the market is going, certainly in the next 3 to 6 months. I will be amazed if those things are wrong. Quick look at the three main indices. Won't spend any time on these because I'm sure you'll be aware of them. But the nationwide, this was the shocker, wasn't it? We were sat there at annual growth of 1.8%. Dropped to 0.6% at the end of December, so it's the final one. And of course, it allowed all the newspapers to pick up the plummet and the plunge word. The P words came out big time when that press release hit the mainstream media. But it means that we ended up the year pretty much about flat, not far away from where we thought. And I will reiterate that point, that with the nationwide, that index is definitely skewed. And the way that algorithm works, because of the transactions up in the north and northwest of England, actually throwing the thing out. And I think it has been a lot tougher this year than the nationwide index tends to indicate there. Importantly, price growth is slowing. As I mentioned earlier on, first-time buyer affordability is going up. Well, I've already sort of given you the spoiler on the right move, haven't I? Minus 1.8, 10-year long-term average is minus 1.4 for December. What it means, though, year on year, is pretty much asking prices haven't moved, 0.6% down, in fact. But that in itself really speaks volumes. So you've had a year where we've had a significant increase in volume of sales. Prices haven't moved. I think that reflects everything that we're seeing out there. The Zoopla, with their different algorithm, I think possibly one of the most accurate algorithms of the three, 1.1% inflation. Again, they're pretty much saying that the market's not moved. I do like their regular check on the pulse of how things are going. These were their November numbers that they published in December, and you can see buyer demand down 12%, pretty much reflects what we were saying just now, doesn't it? With the shift on Rightmove too. Flow of new supply was down 8% as well, which meant with the difference in those two, we've got a slight increase of stock of homes for sale, but the number of sales agreed down by 9%. And that's comparing that same month with 2024. I think that reflects it. Everything that we're seeing right now. As far as the RICS is concerned, this is their latest survey, just published, the November survey. I think the only bits that we're going to focus on, first of all, the overall comment, market conditions are generally weak. That matters to us because that's the sentiment that the surveyors are carrying in their head. But in terms of where the market's going to go next, this is what they're seeing. This is volumes over here, the quantity of homes that are going to be sold. And you can see that both short term and long term, they are feeling that they're slightly in the negative. The majority of these, this works a bit like the consumer confidence chart, the GfK chart we looked at earlier. The majority say it's just about the same or slightly in the negative. And then if we look at values, this is very interesting because the mauve line is the next 3 months. The majority of surveyors believe there will be price falls in the next 3 months. But when you look at the 12-month number, this Azure number here, the majority of surveyors believe that we will see increases. For me, that just says that we are going to see another year that's pretty flat on values. I'd be amazed if it's any different. Underpinning it all is this needs-based artificially compressed market, which has now been released, and there sits great opportunity. So we can't move away from that. You can't, if you've got a needs-based customer, someone that needs to buy a bigger house because they have got an addition coming in the family, that need is still there, whatever happens in the background market. The baby's not going away. So that market is right there for us in Q1. Okay, quick look then at the matrix. This is where we were. I dug this one out of the wardrobe. This is where we were last January. This was the matrix. And of course, since then, I've made some changes. On here, you've got stamp duty. And on here, there's no uncertainty index. When we see this morph into a year later, here we are. This is as I see it this month. This uncertainty index has eased. If you go back pre-budget, it was right down here in the very difficult bottom right-hand quadrant, which means it has a negative effect and high impact, the very worst place as far as its effect on the market is concerned. And that has moved back to the middle. Look at mortgage rates. moving back in here as well. Mortgage availability now is actually up in positive because mortgages are readily available. There's a record number of mortgage products available out there. So they've moved back down. Low impact, where lifestyle changes sits now. There's a worrying cloud on the horizon. And I didn't actually make note of it when we looked at the press review, a couple of slides into the deck. The employment market continues to get more and more difficult. Now, I don't want to, there is the AI thing sits off to one side, and some people talk about the effect that that's having on the employment market, and undoubtedly it is. I don't want to overstress that. What I do know is that actually is showing signs of coming under stress, and that will have an effect for us, and obviously negative, and that impact is starting to move that right. In the meantime, up in this top right-hand quadrant, you're still out there on your own, I'm afraid. All of these are incentives that are in the gift of the developer, of the builder. Part exchange, still the big gun, discounts, of course, and using your IFA to build great financial incentives too. So none of the other things that are going on around are really giving you much help. This is stuff, you've got to do the heavy lifting. And I think that is a really interesting, it's a long time since this matrix, this top right-hand quadrant here, has actually featured anything other than light blue aspects, so developer builder aspects, and led that way. So what does that actually mean then for 2026? Well, this is it now. This is the moment of truth where I'll be looking at this in a year's time. Hopefully, God willing, I'll be looking at this in a year's time and saying, oh, look at that, nailed it again. I feel very confident. I certainly feel very confident about the first 6 months. Lots of things could happen before we get to the end of the 12 months. But this is how I think it's going to go. Excuse me. This is the average price. I'm sure you're aware that's currently sitting at 271k according to the Nationwide, and that is where I think it's going to go. I think we're going to see an uptick in that coming into the spring, even to the extent that I think we're going to break a new record for the Nationwide average price in March, April, 275, maybe even 276. I think that's where it's going to go. And if that's the case, then that 0.6 inflation that we've currently got is going to come up here. Annual inflation, not month on month, to just under 2%, because last January that number dropped quite low, down to 270k, and so I think we're going to see this sort of thing going on. I still believe, I'm absolutely convinced that we're going to have a difficult summer. Let's hope it's a bit like last year, that it was tricky, it was difficult, but not as difficult as I'd originally imagined. But then I think there is really good opportunity to come out of that in the autumn, and with a very strong finish to the year. Crucially, as you can see from the level of this chart here, with no rises in the end, only being between 0.5 and 1% inflation over the year, I think it's going to be another year like that with real problems in shifting prices. I think the volumes are going to be there, but I don't think the price inflation is going to be there. Time will tell, but I feel very, very confident, certainly about the first half of that forecast there, both in terms of average price and inflation year on year. So where does that leave us then in summary? Well, we had this suppression, artificial suppression in Q4 of last year. This creates that that released demand. It's the foot off the hose pipe, and there's a big opportunity for needs-based buyers there. Summer could prove difficult, unless, of course, we do see another interest rate cut. I do think we'll see at least one interest rate cut before the summer, actually. If macro factors stay the same, if Russia doesn't invade someone else, if America don't invade, who knows who's going to invade who? And there's China and Taiwan we've not even spoken about yet. But if all the global background stays as it is, I think there's great potential for Q4 of this year. Overall, over the whole year, I think we're going to be flat pretty much when we get to the other end in terms of inflation. I think there'll be high points and low points, but I think it will be very much like this year in that respect. My price inflation stands at around 0.7% for the year, in between 0.5 and 1%. But I think there'll be another lift in volumes to our highest volumes for I think it goes back 12 years since we did over 1.2 million. But I think there's a really good opportunity there. 1.25, 1.275, that's where I'm seeing transactions. And I think that the new home share will actually just be tiny, just a tiny bit below long run average, sitting at around 10%. So the key for me this year is we are going to see a real variation as we run through the year and all the seasons. A really strong spring, difficult summer, opportunistic autumn and into winter. You've got to have a plan for all seasons. And don't forget, by the way, it's New Homes Week. On the first week in February, the HBF New Homes Week, I understand all the packs have gone out to all the developers. So there is a great opportunity to ride the back of that interest right at the very moment that the market is going to be probably at its strongest until we get right to the back end of the year. So for heaven's sake, take advantage of all that. So hope you've got your plan for all seasons. I hope you've got your diary marked down for Thursday, the 5th of February, because that's going to be our next market cast. And already we'll be able to see whether some of those predictions are looking right or looking wrong. Great big thank you to the production team this morning, to Joan and to Luke, who've done a fantastic job. Thank you. And I will see you a month from now.